Hi, welcome to this video day, which is all about Forex trading strategies for beginners. And what we're going to do today is looking at putting together a simple technical trading strategy for profit. Now, most beginners who want to get started in the markets want to trade with a technical trading approach. Most traders actually either overcomplicate their trading or totally misunderstand what makes a successful technical trading system. So what we're going to do in this video is review some key points in terms of building a strategy that's simple and can help you win at Forex trading. So let's review the points and go to a quick storyboard. Right, let's go through some effective Forex technical analysis techniques that can help you make money from the markets. And let's just look first of all at some lessons from a study that was done by the Wall Street Journal, which I think is very important. And what they did was they got a group, I think it was about 80 traders. They were all successful trading without the internet, and the internet was just becoming popular in terms of trading at the time. And basically the Wall Street Journal wanted to see how much better these traders would do trading over the internet. And now what they did was they monitored them for a year trading on the internet. Yeah, they would all traded without it before, and then they analysed the results. And the Wall Street Journal were actually quite surprised, because they found that 70% of the group of traders were less profitable trading over the internet than they had been before, and close to 30% actually had big drawdowns, i.e. of 50% or more. Now, the internet obviously is a fantastic tool. It makes our trading very convenient, for example, but there are dangers in terms of the internet, which this study reveals, basically. Now, before the internet, these guys were not checking price action that often because they couldn't. Now they were checking price action more often. The Wall Street Journal found they were moving to shorter term time frames. They were also tweaking their strategies, because obviously on the internet you've got numerous studies that you could do on price action. I think the lesson here is stay to the higher time frames. I hear a lot about people making money on 5-minute charts, 15-minute charts, etc. It's rubbish. I just do not believe it. Never seen any trader make money in those short time frames. Also, beware of tweaking your strategy or complicating it. Simple is best, okay? And I think that strategy is one that anyone should keep in mind when coming in to trade the markets. The internet is convenience, okay? But it can be very dangerous, in terms of making stuff too complicated or trading in time frames that are too short. Now, in terms of price action trading, simple support and resistance trading and reading candles, okay? So you're not going to be using any indicators. You can make money this way for sure. Most people can't make money with price action trading, though. Now, what I would say is you could use very simple technical formations, okay? Just very simple. You don't need anything complicated. All these wacky formations or patterns you see, like Gartley patterns, they're a complete waste of time. They're too complicated. Simple is best. Now, in terms of you using a simple support and resistance strategy, you need to learn how to read the candles in context with the support and resistance. It's not a question of using one candle to confirm a move or whatever. You need to see the psychology through several candles, i.e. how the candles are evolving. Now, I would strongly recommend, in terms of doing this, you get a good book on the subject, and the best book probably is Siku Shimutsu's Japanese Chart of Charts, which I think is an excellent book. Now, a lot of people think Steve Neeson is the expert at candlestick charting. He actually copied, let's say, a lot of Siki Shimutsu's work, or basically used it in his own. I'm not saying Steve Neeson's books on candlestick charting aren't good, but I actually would say that the original is the best. So if you can get hold of a copy, get hold of a copy. In terms of, learn candlestick charting from people who claim, sort of secret methods, or one candlestick formation works above all others, all that sort of stuff. It's all nonsense. Okay. Now, in terms of using support and resistance and reading the candles, simple rules only. Okay. You have to use subjective judgment. Okay. Now, in terms of this, all chart formations are different, so you need to focus on, if you're a beginner, a few setups only and master them. In fact, I would say you should just focus on one when you start. Now, I have put the art of small circles. Now, what is that? Well, basically, it's when you've got something that is very simple, but you practice it and refine it, okay? Now, despite what anyone might say, Forex trading is very simple, but there is a degree of subjective judgment that comes from experience. You've got to practice. You're not going to become a good chartist overnight. Charting is not a science, it is an art form. Okay. Now, in terms of setups, you can learn. There's plenty that can make money. I've just got 3 of my favourite price action setups here. My favourite is the first one, which is tight range breakouts. This is just such a great setup. What you're looking for is tight sideways action, low volatility with the candles very small, moving within a range, then wait for a high volatility candle to break the range and go with the break. It's a great setup, and the logic on it is pretty simple. Supply and demand are obviously in balance behind the chart as prices travel sideways, then something has changed in the fundamentals to cause the high volatility breakout. Don't need to know the fundamentals to trade this setup. As George Soros once said, when you get a move like that, just trade it and investigate later. I fully agree with that. It's also a favourite chart setup of Bruce Kovnar, one of the greatest traders of all time. It's very simple, but you just focus on that one trade setup. I bet you could make a lot of money over time. I also like failed breakouts. Let's face it, in terms of breakout trading, most breakouts fail. So looking for failed breakouts is a good idea. Exhaustion of moves is one I particularly like, when you get price spikes where candles become highly volatile, they accelerate to the upside or to the downside, and then you'll get exhaustion. In terms of exhaustion, there's a few candle setups I look for in this, and it's highly effective in my view in getting the risk reward on your side, because your risk is always less than your reward when you're trading price spikes, as long as you can judge it, of course, correctly. Forex trading with indicators, should you do it? A lot of traders say, well, everything is in the price action, just follow the price. I don't totally agree with that. I think, in terms of price action trading, I've said you can make money just looking at price action, but if you look at the top fund managers in the world who use technical trading systems, they will use indicators, and the favourite indicator is volatility. Okay. Now, in terms of this, I put the no-brainer strategy from hedge fund manager Jim Leitner, who said use mean reversion strategies in daily and weekly time frames, and they will always get the odds on your side. I totally agree. Mean reversion is a great way to trade. It's one of our favourite trading strategies. What's mean reversion? Just basically means you'll come back to a mean or an average price. So prices will spike away, let's say, from a moving average, and then they'll come back to it. Now, the simplest way of doing mean reversion is to use Bollinger Bands. You've got a mid-band, which is a 20-day moving average to the mean, and then the band will measure as a standard default 2 standard deviations away from the mean. Okay? Very effective. You don't have to use Bollinger Bands. You can use various moving averages or standard deviation indicators. But if you understand volatility and you measure it in relation to your price action trading, I personally think, yeah, it's very, very effective. I'm not in favour of cluttering with too many indicators. They're backup mostly. Your signal should come from the price action itself and the chart formation. But I love volatility, as you can probably gather. Other tips: trade daily time frames. That way, you'll have filtered out the noise. The lower the time frame, the more noisy the price action as a general rule. I do know people who make money trading the 4-hour chart, some on the 1-hour chart, but once you get beneath that, the noise levels become too high, and then you'll fail. You won't get the odds on your side. I said it earlier, minimum of rules. Don't make your entry criteria too complicated. Focus on trading the psychology of price right now. This should be obvious, but most traders don't do it. You've got this big tendency to look back at every twist or turn of the market from weeks or months ago. A good example of this would be Gartley patterns, those other predictive ways of trading. It doesn't matter what happened in the past, all those twists and turns. The market is focused on the here and now. So that's what you need to do. Okay? Do not fall for predictive patterns and so forth. Public love them. And it appeals to all beginners to predict what might happen next, not have to use any subjective judgment. But it doesn't work. Forex prices cannot be predicted. Keep your analysis quick. When you first start learning to trade, you will take a little bit of time when you look at the charts. That's natural, you're getting used to things. But when you come to trade for real, it shouldn't take too long. You should be able to look at a chart and decide if you can do anything with it or not. There's no thinking should come into it. You'll just know, especially if you've practiced simple trade setups. Now, a mistake a lot of traders make is to try and find a setup, even though it might not be there. They think about it and they debate it. They just want to trade, so they want an excuse to trade. Don't do that. If you don't see a setup, then don't trade. Do not try and force money from the market, because you just will end up losing. Okay, taking low odds trades. Final point, stop is as important as the target. It is. And you get a lot of traders, they put their stops too close and they think they've increased their risk to reward. So they might have a close stop, okay, and have a target, and they'll say, oh, well, my risk to reward is 5 to 1. That isn't the risk reward, is it? That's just a subjective opinion. The odds of it coming right might not be great because the stop is too close. It's a common error to put the stop in the noise. If you give the stop a bit more room, you might, let's say, have a risk reward of 3 to 1. But because your stop's further away, then that setup has got more chance of being successful. You must never ever drop your stop in the noise of the market, okay? And never drop it where other people are going to put their stops. Put as much thought into the stop as into the target, and also give the market room to breathe as well. Right, I mean, they're fairly simple tips I've given above. Obviously, it is my view of technical analysis, but in terms of all the points I've gone through, I know a lot of traders who make money trading in the way that I've described. Now, that is the video for today. Thank you very much for watching me as usual. Take care and have a good day.